Welcome to a journey through the intricate world of behavioral finance traps. Did you know that overconfident investors often earn 3% less annually than the market average? In this eye-opening series, we uncover the hidden dangers that lurk behind every financial decision. From the allure of quick gains to the pitfalls of following the crowd, each chapter reveals strategies to protect your wealth and make smarter choices. Get ready to navigate the complexities of finance with practical tips and real-world insights. Let's dive in and uncover how to avoid these common traps and secure your financial future. Chapter 1. The Illusion of Control, When Confidence Becomes Costly. Welcome to the first chapter, where we tackle the illusion of control. This is a sneaky trap where we overestimate our ability to control events, especially in the stock market. Imagine this: you've made a few good trades, and suddenly, you think you're the next Warren Buffett. That's overconfidence in action. Studies show that overconfident investors trade more frequently, often leading to lower returns. According to a study by Barber and Odeen, overconfident traders earned less than the market average by 3% annually. Here's a simple strategy: diversify your investments. Don't put all your eggs in one basket. Use index funds to spread out risk. And remember, it's okay not to have all the answers. Stay humble and keep learning. As Warren Buffett says, the stock market is designed to transfer money from the active to the patient. Next, let's talk about setting realistic goals. Don't expect to double your money overnight. Instead, aim for steady growth. Even a 7% annual return can double your investment in about 10 years thanks to compound interest. Lastly, get a second opinion. Consulting with a financial advisor can provide valuable insights and help keep your overconfidence in check. Chapter 2. The Scarcity Trap, Urgency versus Smart Investing. Now, let's dive into the scarcity trap. This is when marketers create a false sense of urgency to push you into making quick decisions. Think about those limited time offer deals. They make you feel like you have to act now or miss out forever. But here's a fun fact. These deals often come back, sometimes at an even better price. To avoid falling into this trap, take a step back. Give yourself at least 24 hours to consider any big financial decision. This cooling off period can save you from impulsive mistakes. Another strategy is to set clear investment criteria. Know what you're looking for and stick to it. This way, you won't be swayed by flashy ads or scare tactics. Let's talk data. A study by the University of Chicago found that consumers who waited before making a purchase were 50% less likely to regret the decision. And here's a quote to remember from Warren Buffett: "The stock market is a device for transferring money from the impatient to the patient." Lastly, automate your investments. Setting up automatic contributions to your savings or investment accounts ensures you stay on track, no matter what urgent offers come your way. Chapter 3. The Sunk Cost Fallacy, When to Walk Away. Our third chapter is all about the sunk cost fallacy. This is when you continue investing in something because you've already spent so much on it, even when it's a losing proposition. Imagine you've bought a stock that's tanking. Instead of selling, you keep buying more to average down your cost. But sometimes, it's better to cut your losses and move on. One strategy here is to set predetermined exit points. Decide in advance the maximum loss you're willing to tolerate and stick to it. This takes emotion out of the equation. Another tip is to regularly review your portfolio. Ask yourself if you'd buy each investment today. If the answer is no, it might be time to sell. Here's an interesting fact. According to research, people are twice as likely to continue with an investment if they've previously spent money on it, even if it's a poor choice. To avoid this trap, focus on future potential, not past costs. Remember what Warren Buffett said: "The most important quality for an investor is temperament, not intellect." Lastly, surround yourself with a supportive network. Having friends or advisors who can provide objective opinions helps you see clearly and avoid emotional decisions. Chapter 4. Anchoring Pitfalls, How Initial Information Misleads You. Welcome back. In this chapter, we'll explore anchoring, a trap where the first piece of information you receive heavily influences your decisions. Let's say you see a stock priced at $100. If it drops to $80, you might think it's a bargain. But what if its true value is only $50? That initial $100 price has anchored your perception. A key strategy to avoid this trap is doing thorough research. Look at multiple sources and consider different perspectives before making a decision. Consider this: A study by Tversky and Kahneman found that even experienced professionals are prone to anchoring, affecting their judgment and decision-making. To counter anchoring, set your own benchmarks based on comprehensive analysis. Don't rely solely on initial prices or information. Here's a practical tip. Use fundamental analysis to determine a stock's intrinsic value. This includes looking at financial statements, company performance, and market conditions. Another interesting fact is that anchoring can affect negotiations too. The first number thrown out often sets the tone for the entire discussion. Remember the wise words of Charlie Munger. You don't have to be brilliant, only a little bit wiser than the other guys, on average, for a long time. Lastly, be aware of your biases. Regularly questioning your assumptions helps you stay objective and make better financial decisions. Chapter 5, The Herd Mentality, Avoiding the Crowd's Mistakes. Moving on, let's talk about herd mentality. This is when people follow the crowd, thinking that if everyone else is doing it, it must be right. Think about the dot-com bubble. Everyone jumped on tech stocks, inflating prices until the bubble burst, causing massive losses. A smart strategy is to do your own research. Don't buy a stock just because it's popular. Analyze its fundamentals and long-term potential. Here's a fun fact. A study by Dalbar found that the average investor earns significantly less than the market average due to herd mentality and poor timing. To avoid this trap, develop a contrarian mindset. This means questioning the status quo and making decisions based on independent analysis. Remember Warren Buffett's advice: be fearful when others are greedy and greedy when others are fearful. Another tactic is to diversify. Don't put all your money into trendy stocks. Spread it across different sectors and asset classes to reduce risk. Interesting data shows that during market downturns, those who avoided the herd and stayed invested in diversified portfolios fared better in the long run. Lastly, set long-term goals and stick to your plan. Ignore short-term market noise and focus on your financial objectives. Chapter 6, Confirmation Bias, Seeing Only What You Want to See. Welcome to Chapter 6. Here, we tackle confirmation bias, where people favor information that confirms their beliefs and ignore contradictory evidence. Imagine you believe a company will do well. You seek out positive news and overlook red flags. This can lead to poor investment decisions. A key strategy is to seek out diverse opinions. Read analysis from both bulls and bears before making a decision. Interesting fact: a study by Stanford University found that people are twice as likely to search for information that supports their existing views. To counter this bias, play devil's advocate. Challenge your assumptions and consider worst-case scenarios. As Ray Dalio says, triangulate your view with believable people who are willing to disagree with you. Another strategy is to keep an investment journal. Write down your reasons for buying or selling a stock and review them regularly. This helps you stay objective and learn from your mistakes. Here's a practical tip. Use data and evidence-based decision-making. Rely on hard facts rather than opinions or headlines. Lastly, remember to stay flexible. The market is always changing, and being adaptable can help you navigate through uncertainty. Chapter 7, The Gamification of Finance, Fun, but Dangerous. Welcome to Chapter 7. Let's talk about the gamification of finance. Apps and platforms make investing feel like a game, which can be risky. Think about apps like Robinhood. They use confetti animations and instant notifications to make trading exciting. But this can lead to impulsive decisions. A good strategy is to set limits on your trades. Decide how much you're willing to invest and stick to it, no matter how tempting it is to keep going. Interesting fact: according to a study by Behavioral Finance, traders on gamified platforms are more likely to trade frequently, which often results in lower overall returns. Another strategy is to educate yourself. Understand the basics of investing before diving in. Read books, take courses, and learn from reputable sources. Warren Buffett advises, the stock market is designed to transfer money from the active to the patient. This means that patient, informed investing beats impulsive trading. Also, consider using a traditional brokerage for larger investments. These platforms might lack the flashy features but often offer better tools for research and analysis. Here's a practical tip. Set long-term goals and create a plan. This helps you stay focused and avoid getting distracted by short-term gains or losses. Lastly, use the app's educational resources. Many platforms offer tutorials and articles to help users make smarter decisions. Take advantage of these tools. Chapter 8, The Fear of Missing Out, FOMO, Risking It All for Hype. In Chapter 8, we'll tackle FOMO, or the fear of missing out. This is when you make decisions based on the fear of being left behind. Imagine seeing everyone invest in a new hot stock. You jump in without researching, just to be part of the hype. This can be dangerous. A key strategy is to stay informed. Follow market trends but don't let them dictate your decisions. Do your own research and invest based on facts, not emotions. Interesting fact: a survey by Charles Schwab found that 33% of investors admitted to making impulsive investment decisions due to FOMO. To combat FOMO, create an investment checklist. Outline what you're looking for in an investment and only proceed if it meets your criteria. As Charlie Munger says, the big money is not in the buying and selling, but in the waiting. Another strategy is to diversify. Don't put all your money into the latest trend. Spread it across different assets to reduce risk. Here's a practical tip: use a cooling off period. Give yourself time to think before making any investment decision. This helps you avoid impulsive choices. Lastly, focus on your long-term goals. Remember why you're investing and stay true to your plan, regardless of market noise. Chapter 9, The Status Quo Bias, Comfort Zones and Missed Opportunities. Finally, in Chapter 9, we'll discuss the status quo bias. This is when you stick with what you know, even if it's not the best option. Imagine keeping your money in a low-interest savings account because it feels safe. You miss out on better opportunities for growth. A smart strategy is to regularly review your investments. Assess whether they're still the best choice for your goals and be willing to make changes. Interesting fact: according to a Vanguard study, investors who regularly rebalanced their portfolios saw higher returns over time compared to those who did not. To overcome status quo bias, educate yourself about different investment options. Learn about stocks, bonds, real estate, and other assets. As Warren Buffett says, risk comes from not knowing what you're doing. So, the more you know, the better decisions you'll make. Another strategy is to set specific financial goals. This helps you stay focused and motivated to make necessary changes. Here's a practical tip: use a financial advisor. They can provide an objective view and help you make decisions based on data, not comfort. Lastly, stay adaptable. The market changes, and so should your strategy. Be open to new opportunities and willing to take calculated risks.